In today's video, we're going to talk about the top 5 ways to succeed with algo trading and how to ensure that you have the highest probability of actually achieving success and long-term performance with bots. So the first big pillar here, which I've talked about many times on this channel, so I won't go too much into the weeds, is to build a portfolio. And this really comes down to there is no such thing as a magic bot. Some bots will do great in certain market environments while they won't do nearly as well in others. And if you really want to achieve consistent performance, you need to have a large portfolio of bots. And this is frankly, not just my opinion, it's really seen on the brokerage side. If you look at enough client data, people who do well, generally speaking, run portfolios. And by kind of being a little bit in the brokerage industry, we can see this, we know this, and you also just talk to people who work at brokers and they can analyze thousands of data points. And frankly, you can see that people with the most success usually run portfolios of bots, just because you really have the robustness across regimes. Because let's say a market environment changes and one bot stops working, maybe your portfolio's total performance gets dragged down a bit, but you can see that clearly something's not working. You can take it off and then perhaps you can add another bot. And this really leads us to point number 2. Another massive way to succeed with algo trading is to have a systematic way of knowing if a bot is broken or not. And more importantly, this helps you not take bots off an account too early just because of emotion, not because the bot's actually no longer effective. And a great example of this is I have clients sometimes that will send an email if a bot has 4 losses in a row or 5 losses in a row, and they'll be concerned oh no, is something wrong? And the main thing you have to do, and it's a justifiable concern obviously, but the main thing you have to do is you have to look at a long enough back test of a given bot and see what the total maximum amount of losers in a row can be throughout a back test. And yes, there are more statistically robust measures of doing this, but the simplest way of doing this is to run a 5-year back test, and you can see if a particular strategy has a maximum sequence of losers of, let's say, 12 trades over a 5-year back test. If you have 4 losers in a row, it certainly does not mean that this strategy is unprofitable. It just means that, hey, you're within the normal sample of distribution of losers and winners. Because let's say every time you have 3 losers in a row, and on a bot that has a 50% win rate, you freak out and you take it off the account. All of a sudden, you're completely interrupting your edge because you're not letting the edge actually play out. So one of the most important things in algo trading, and I found this in my own journey, is have rules in place where you know something is broken and you know something's fine. And this enables you to then be a lot more systematic and not just let emotions get the better of you. Because sometimes bots do break, your edges can decay, and then you have to be able to know that and then remove it. But especially if you have a portfolio, you have enough time because you're not trading with all of your leverage in one particular bot to notice this and to take action in a systematic way. So this is also a really, really important factor. The third one here kind of ties into the first two is don't over leverage. And frankly, if you're using too much leverage, you can't necessarily let an edge play out. Because let's say if you lose 50% of your account, you need to make 100% to make it back, right? So if you go into an overly deep drawdown, you're just massively destroying your capital, and it's really, really hard to make that back. So even if you have a system with an edge, let's say if you were to run it with good risk, you'd have a 10% drawdown and a 100% annual return. Let's say you 5x that because you want to have a 500% annual return, but maybe you'll have a 50% drawdown. All of a sudden, if you just so happen to start this portfolio during more of a rougher period, you can have a nasty drawdown, and then it will take you forever to actually recuperate that investment. And also, if you have a really hefty drawdown, most people will get emotional about this, and they'll all of a sudden start to interfere. And in doing so, they can really hurt their total performance just because they over leveraged. So you can take a system which is fantastic, which in all other scenarios would have made a ton of money, but if you just use way too much leverage, you can completely negate your edge. So not great. Another big factor here is obviously the individual bots need to be good. So if you build a portfolio and it's full of crap, you're just diversifying as opposed to diversifying. And the main factor here is don't use overfit bots. Each bot should have a strong logical premise behind it, and there has to be a reason as to why it works. So some people will use different kind of techniques to make sure that their bots are not overfit. Some will do walk forward analysis. Some people will do robustness tests. My personal favorite method is I want to always ask myself, why am I getting paid by this strategy? What edge am I capitalizing on? and I want to have a strong fundamental idea behind it. So I find that simplicity and logic and having a strong financial reasoning behind something is really the safest way to ensure that something's going to print. Like for instance, if you are just buying something which generally goes up and you're using a filter based on smart money, that's probably a pretty good strategy. If you're trying to make something which is a combination of 17 RSIs and picking the best combination, I personally would not trust that with my money, just because there's so much potential for data fitting there, and for overfitting and data mining, that it's just way too risky. And finally, the fifth one here is don't interfere with the edge. And this particularly happens with high risk reward systems, where people will manually start to close trades and they'll just start messing with the bots. And it's very tempting to do so. Like, let's say you're trading a system that has a 3-to-1 risk reward and you go 2R into profit and it starts to pull back. A lot of people will be like, oh no, I want to salvage my 2R. Let me go and close this trade. However, quite often, even if there's a little bit of a pullback, it will then re-reverse and go and hit your TP or hit your level that you were expecting to close at. And in doing so, if you close enough trades prematurely, humans are far more likely to be scared of loss than be scared of not having a win. So people are far more likely to mess up their edge because they'll close their winners too quickly, and oftentimes they'll let their losers run. And this can completely negate or adversely affect your risk reward. So don't mess with the bots. Once they're on the account, just let them do their thing, because anytime you mess with the bots, I have found over my experience and seeing lots and lots of people by now, and my own experience too, like, you almost always regret it. So if you have a system that has an edge, let it do its thing, and as long as the steps 1 through 4 have been followed properly, you should be good to go. So guys, leave me a comment if I'm missing something here, but these are some of the most critical factors which I have observed through my algo trading career so far. Cheers.